Hello and welcome. I hope that you are having a fantastic day. Today, we're going to talk about our cryptocurrency algorithm trading. So, February 2020, the last week of February, was a bloodbath when it comes to cryptocurrency and really to any other asset out there, whether it's stocks, bonds, or something else. We're also going to look at how we went from 37 coins all the way down to 9 coins. And then finally, we're going to end by, should we hodl to hodl or not to hodl? That is the question. Let's get right into it. Can we get the 99 likes on this video? Smash the like button. It really helps us out. I'm not a financial advisor. This is not financial advice. This is my opinion. So, let me tell you a little bit about my discovery that led me to write my cryptocurrency algorithm. The discovery is pretty simple. If you invest $1,000 in Bitcoin and hold it for 3 years, 3 years later, you're going to make some money. From January 1, 2017 to December 31st, 2019, your $1,000 would have been worth, at the end of 3 years, $7,206. And you can see through this progression over the last decade that Bitcoin has existed that every 3 years you would have made money. In fact, the worst 3 years, you still made 18%, and that's better than most banks would have given you over a 3-year period. Trying to get 18% over a 3-year period can be tough. So even in the last 3 years, $7,206 is a 7x increase. You made 7 times your money just because you bought Bitcoin and held it for 3 years. And so really the important point out of this is that it's more important to try and hold cryptocurrency longer than shorter. And a lot of people, they see the price drop dramatically, it scares them, and so they pull out of cryptocurrency a little bit too early. I took the opposite strategy when I first got in because the guy I was listening to, that I was paying attention to his recommendations, told me to just buy and hold and don't sell until he says sell, which is years later. And while I can understand his strategy, I just did not like the ups and the downs that cryptocurrency has a tendency to go through. I mean, here's a chart that pretty much shows us from the beginning of the year, December, all the way, actually starts at about November. It really starts around Thanksgiving. 11/22 is where this chart starts. We can see this really nice gain as Bitcoin increased up to this price, but then we can see this really steep drop where it went from, somewhere in the $10,000 price range all the way down into the $8,500. And so that's a good 15% drop. And why would you want to lose 15% of your profit? And so while hodl can be a great strategy, there may be a time where you say, okay, I'm going to pull out short term. I'm going to sell off and get back in at a later date. So anyway, we're going to look at 3 things: the crypto bloodbath, the 37 to 9 coins, and to hodl or not to hodl. So the first thing was this crypto bloodbath. We can see we went from, on February 12th, a high of $10,300, $10,500, somewhere in that ballpark, all the way down to, this is a low of $8,492. And so, that's a good 15% drop, and it occurred over about a 2-week period. The massive part of the drop is starting here with a high of $9,951, and it dropped, like I mentioned, all the way down to a low of $8,492. So here's the big deal. Over the last week, cryptocurrency has dropped dramatically. You can see this is Sunday's price, this is Monday's price, this is Tuesday, Wednesday, Thursday, Friday, how it just had this continued downturn. Not only did cryptocurrency fall, but every stock, every market out there also fell. And so it was a very dramatic dip in the entire any investment out there. also saw a significant drop. But was this drop based off of any rational expectation? Maybe. It depends on how bad you think the coronavirus is going to be. And at this time, to think that the coronavirus is going to be some worldwide, apocalyptic event is a little bit on the early side. And so this sudden 15% correction may be a rational correction, or it could be an overcorrection. Only time will tell. But anyway, the key thing is that we saw a huge, everything went into the red. Everything went from being profitable to suddenly losing all of their gains, or a good portion of their gains, for the last month and a half. And in some cases, a lot more than that, depending on which cryptocurrency you're talking about. Now, my cryptocurrency algorithm prior to this big drop, right here, my algorithm was recommending 37 coins that you would be invested in. And then after this big drop yesterday, it was down to 9 coins. And you can see in this price range. And so my algorithm was recommending during this big drop that you sell off a lot of coins. And that's what my algorithm is designed to do. It's designed to preserve your profits when the market is tanking. And so the algorithm will watch for a good time to get back in, but it is trying to prevent any significant losses. And that's why the market has a tendency to overreact, because a lot of algorithms are driving what happens in the market. And when those algorithms see the prices start to move to a negative direction and move enough that it triggers their sell signals, then that algorithm has triggered other algorithms, because the other algorithms saw the first algorithm selling its stock. And so it kind of becomes a self-fulfilling prophecy as multiple algorithms all over start getting triggered and start selling stuff off. You see a much bigger reaction in the market than would be a rational reaction. It's a reaction driven off of fear, and it's a reaction driven off of what the other algorithms are doing, rather than saying, okay, is Amazon still valued at, whatever it was 5 days ago, a week ago? Is this stock really changed that much? And looking at it more from a logical, rational perspective, it tends to be somewhat emotional and somewhat more about, what is everybody else doing? So it's kind of a herd mentality. And so even though it is a herd mentality, sometimes, as my algorithm pointed out, sometimes it's best to kind of follow the herd. Now, let me give you 2 of these 9 coins that my algorithm is saying stay in. So this is the first of the 2 coins. You can see here, this is the Bitcoin chart. And in the Bitcoin chart, we can see that back a year ago in February, it was recommending a buy, and these blue dots represent the price to exit. So when you see a blue dot, my algorithm is recommending purchasing the stock, and then it also provides, this is the price that you want to sell it if it suddenly drops down and you see it get to 9,000, in this case, $9,247. It wanted you to go ahead and sell and get out of it. And you can see right here, as we've gotten into this big red candle, all these price things are getting in the way of the candle. But you can see at the end, this big red candle in this weekly chart was a sell candle. So let's zoom in. I'm going to click the 3-month button here. And by clicking the 3-month button, we can see more of the details. And so here's the great big red, the red candles from last week as the price dropped from a high of almost $10,000 all the way down to the $8,572 price range. And you can see the blue dots as they've gotten closer and closer, but they never quite touched the candles. And so the algorithm never quite told us to sell Bitcoin, even though it got very close. At $8,250, we would have gotten a sell signal, but the lowest it got to on this last candle was 8,537. And so the algorithm has continued to recommend owning and holding Bitcoin. And then this is the other one I wanted to share with you. This is a cryptocurrency called Link. And if you look at the blue dots, you can see there are weeks where it says to buy it and weeks that it's out. And then over here we had a longer period stretching from July all the way out to September where it said stay out of Link. And then it had a period from September over here to November where it said purchase Link. And then again it had us get out. And so you can see by the pattern of this algorithm that it's getting you into the crypto when it's on a strong upward trend, and then it has you sell out as it's going down. And then here it's picked another nice upward trend and then had you sell out. And then here it was picking a really nice upward trend from January all the way up here to February 24th. Let's zoom in like we just did with the other one into the 3-month chart. And you can see here where on January 7th, it recommended that you purchased, and this is Link. I don't think I mentioned it, but this is the Link cryptocurrency. And so you can see where it recommended that you buy Link and had an exit price of $1.98, and Link stretched between a low of $1.90 all the way up to a high of $2.13. And then it continued, the blue dots continued, and it gave it enough room that Link could do its own stuff. And even here, you can see that Link came all the way down to our buyout price, but never quite hit it. Here, the low is $3.48, and the exit price was at $3.46. And then here, the exit price was at $3.52. Now, the low did go below the $3.52, but my algorithm continued to hold it because my algorithm only evaluates it on a daily basis, and the close price was still higher than the exit price, and so it continued to hold. And then the same thing here, its exit price was still a bit higher than the close price. The close price was $3.95. The exit price was $3.57. The low of the day, if you had reacted to the low of the day, you would have sold Link. But the algorithm would have held it because the algorithm only checks it once a day, and that's at the close of the day. And so it has continued to hold all the way through here. And as of March 1st, the exit price was at $3.72. And the close of the day was at $4.54. And so that's the numbers that the algorithm was instructing us. It was the purchase pattern that the algorithm was recommending. So we've talked about the February 2020 crypto bloodbath and how it wasn't just cryptocurrency, but it was really any asset, any investment. We've talked about how the algorithm went from 37 coins all the way down to 9 coins. So let's conclude with, should we HODL or should we not HODL? And that's not an easy question. And that's one of the reasons why I wrote this algorithm, because I noticed with my own desires, I couldn't really follow my desires because they don't know. Anyway, bottom line, I wrote the algorithm because I wanted a mathematical way to tell me to buy and to sell that had some kind of repeatable, verifiable history. And that's exactly what the algorithm does. It goes out, it runs over 3,000, a little over 3,000 different parameters in order to try and find the best combination that makes the most profit. It records how much profit or loss each one made over the last 12 months. And then out of the 12 months, it picks the set of parameters that was the most profitable, and it uses those parameters in order to create the chart that I'm showing you. And so this chart is based off of the most profitable set of parameters for the Link cryptocurrency. And this is the recommendation that those parameters provide in terms of when to buy and when to sell. And you can see here from the blue dots that it did a very good job of picking the best times to buy and the best times to sell. And so that's really the whole point of the algorithm, and it's really a combination of HODL and not HODLing, because a lot of people like to try and day trade. I don't have the time or the interest to day trade. I mean, if I was able to sit in front of my computer all day long for more than 16 hours a day, since cryptocurrencies is a 24-hour market, and then be willing to have something alert me in the middle of the night and suddenly get up and go and buy and sell stuff, that would be a different matter. But I don't want to have my life run that way. And from what I can tell from my own back testing and my own research and study, I'm not sure I would actually make more money by doing that. In fact, as I showed you here, my discovery was that you made more money just buying and holding for 3 years. And so if you don't have an algorithm like mine, go ahead and buy and hold for 3 years. But just remember that during each of these different 3-year periods, there were times where your investment would have dropped in value anywhere from 60 to 80%. You would have seen, as in some cases, a 50% loss, and in other cases you would have seen closer to an 80 and maybe even a 90% loss during that 3-year period. So in other words, a 90% loss on your $1,000 investment means that somewhere during this 3 years, that investment was worth maybe $100 or maybe $200. And so it's somewhat difficult to say, oh my gosh, my $1,000 is now only $100. I'm going to continue to HODL because I have faith it's going to go back up. I wanted to find a better way to deal with this so that I would sell during those downturns where it went down by 80 or 90% in price, and HODL, or own the asset, own the crypto while it's on its way up. And so that's the question, to HODL or not to HODL. I think you want to do something in between day trading and long-term holding. So that's my opinion. I'm going to stick with it. How could I be of service to you? Do you disagree with anything that I said? Please leave your comments below. Look, you know things I don't know. I know things that you don't know. And when we share what we know with each other, we're going to grow smarter together. I want to grow smarter together with you. And if you can share your polite disagreements down below, we will grow smarter together. So in the meantime, like, subscribe, and HODL. And I hope that you have a fantastic day.